Hello, everyone. Today is Wednesday, October 22nd, 2025, and I'm Brian Tokuuke, Portfolio Manager here at the Rice Partnership. Joining me today is our Chief Investment Officer, Orest Saikevych, who will be giving us his third quarter recap and his market outlook for the remainder of the year. Thank you, Orest, for joining us today.
Well, thank you, Brian, and hello again, everyone.
So, Orest, can you start us off by giving us a brief recap of what happened in the third quarter?
Okay. Well, the third quarter, as far as the equity markets are concerned, featured a continued rally from the lows we had in April after a lot of the um, uh, tariff uh, tariffs that were imposed originally were dialed back. So the market's like that. And a lot of the tariff agreements that have happened since then haven't been nearly as draconian as originally feared. In addition, we saw rallies in a lot of the commodities, precious metals. Oil was range bound basically. West Texas was roughly in about a 10% band. Um, bonds the U.S. 10-year Treasury yield was roughly in a 4 to 4.5% band. Since then, it is broken down a little bit. It's now in a bigger band of roughly 3 3/4 to 5, which is basically been the situation for the last 3 years. So overall, markets did quite well. And reasons for that, developments during the quarter. Number one, the tax bill. And the tax bill was passed sooner than we anticipated. We thought it would probably occur around year end. It was passed at the 4th of July, so that was good. As far as individuals are concerned, it's not going to help individuals all that much, but it's more of a positive for corporations, especially those who are thinking of spending capital expenditures. Allows the tax bill allows them to uh, write off the expenses a lot sooner. So that's a positive overall for the economy starting next year. We've had also other things going on. Uh, on October 1st, the federal government had another shutdown. We've had these before where both parties can't agree as far as uh, continuing it to operate. One party or the other tries to hold certain parts of their agenda hostage to the situation. Um, Overall, if the shutdown lasts within a month or so, it shouldn't have too much of an effect on the economy. But then once you start getting past that, and certainly past, let's say, the 6 week mark, it will have an impact on the economy. So stay tuned on that one. One of the other impacts of it is the fact that economists really can't gauge how the economy is doing because a lot of the economic reports are generated by the Bureau of Labor Statistics. And right now, we don't, they haven't been publishing anything this month. We're going to get a CPI on Friday, okay, Friday the 24th here of this month. So we'll glean a little bit what's going on, but really we're in the fog right now as far as that's concerned. Albeit private measures of economic activity show a further moderating of the economy, but not necessarily a precipitous downturn or anything. Uh, Tariff negotiations continue. There are a couple of countries out there that are still, up in the air. One of them is China, and in spite of the rhetoric going back and forth between Washington and Beijing, there should be a meeting between the president and Premier Xi of China around the end of the month. We'll see if they can make progress as far as China tariffs are concerned. Moving on, I think one of the big topics, especially as far as equities are concerned, during the quarter, and it still continues, is AI, and a lot of optimists are seeing it at being a glass half full or totally full, and the pessimists are saying it's half empty. Uh, and they're using the situation, what we had in the late 1990s, ending in 2000, the dot-com bubble, as a model for that, saying that there's excessive speculation in the market, etc. To be true, there is some, okay, but overall, it's our view that uh, a number of things portend the AI trend continuing, and certainly being, in the end, a big positive for the economy. One of them is there is anecdotal evidence of AI, end use AI, especially in finance and healthcare. Okay. And also valuations overall in the information technology sector in particular. They're stretched, but they're not at 2000 levels. Most of the spending that we've had an awful lot of spending in AI. Most of the spending have come from the large tech companies, mostly the Magnificent Seven, that have strong profits and cash flow. So they don't have to necessarily borrow money. Okay. Also, a sign of excess speculation is initial public offerings, or IPOs. In other words, companies that are becoming public, trading on the exchanges. During the dot-com bubble, we had a huge wave of them, and a lot of them would just trade way above their initial offering price, indicating speculation, and most of them came down to earth and crashed, basically. We're not seeing that right now. There are, have been more IPOs this year than in previous years, but the market's been rather selective. There have been some that have run, others have not. So I wouldn't consider that area as being a source of excessive uh, speculation, at least right now. And then finally, the big difference between now and dot-com is the fact that monetary policy is supportive. In other words, during dot-com, the Fed was actually increasing the short-term Fed funds rate. Now they are actually lowering it. So instead of a headwind for the economy, it's a tailwind, which is a big plus, something to keep in mind. What is it? What is our outlook? Okay, if I may anticipate your second question, Brian. What's our outlook? Well, considering the Fed, we think the Fed will ease once or twice more this year, probably twice, but at least once, and that they'll gradually lower rates, at least through the first part of the year. That may increase later on in the year. We'll see. But right now, it looks like gradual decreases of the Fed funds rate for a while. As far as the economy itself, as I mentioned earlier, some of the private economic reports show moderate growth with a continuation of the no hire, no fire labor market. And consumer spending, even though the lower portions of lower income households of the economy are having a tough time, as they very often do, unfortunately, the upper end, the upper half, has been more than making up for it. And so consumer spending in aggregate is doing fine. And corporate profits, interestingly enough, are good. They were very good for the second quarter. For the third quarter, they were initially projected to be around up 7%. Then some people started bumping it up to 8%. So far, and it's early, I realize, in the earnings season, but so far corporate profits are up about 9%, and they may trend a little bit higher. So the outlook overall for corporate profits looks good for this quarter and possibly for next. As far as what we're doing, we continued with our overall process of adding to international equities in the third quarter. We want to continue to diversify portfolios while taking advantage of potential growth abroad. And keep in mind that the White House wants a lower dollar, if for no other reason than to help with the trade deficit, to lower that. So a weaker dollar would help. And one of the consequences of a weaker dollar is for U.S. investors invested in foreign stock and bond markets, it's a tailwind. So that's a plus, another plus for international investments. So overall, our outlook is for steady as she goes. We may have a bit of a pullback, but it's only in the context of a longer term bull market. Things had gotten a little bit speculative here in the last month or two, but we think the overall trend is higher and overall steady as she goes.
Cool. Awesome. Thank you very much, Orest. Well, that's about all the time we have today. Thanks, Orest, for your third quarter recap and outlook. We really appreciate you sharing your knowledge and giving us your time. And to everyone viewing, thank you for tuning in.
Thank you. Take care, everyone.